Recently, on one of the biggest podcasts in the world, Nischa Shah spoke about lots of things covering retirement and saving.
Principle with investing is very, very simple, and it's just keep it simple and do it for the long term. So I say index funds and target date retirement funds is what you want to invest in. And I keep it very, very diversified. S&P 500 target date retirement funds that automatically rebalance. So target date retirement fund, for anyone who's listening and wondering what it is, it's essentially a fund that has different types of investments within it.
So what even are these retirement date funds that she's talking about here? And why do I have a problem with them? Well, my name's Ross Kelly. I'm a level 4 diploma holder in regulated financial planning. And in this video, we're going to go over why these retirement date funds might end up possibly ruining your plans for retirement. Now, first and foremost, I just want to say this isn't a slight or a hit piece on Nischa. She's done some great stuff in the personal finance space on YouTube in a really short amount of time. And she's, well, seen a lot of success as a result of it. And frankly, we could do with more people like her on this platform, spreading, just realistic, helpful advice for people to get by day to day with their finances. And for the most part, in the interview, she gave some really good, helpful, actionable tips that people just starting out could really do with hearing. Now, of course, as humans tend to do, I did have a few disagreements about things, but the one major thing I had a disagreement on was the 2 times that she talked about target date retirement funds and how she uses them and how she definitely recommends people to also use them. So what are these retirement date funds that she's speaking about, and why do I happen to have an issue with them? Well, retirement date funds are what are called fund of funds. So instead of a traditional fund that's made up of owning a selection of stocks and bonds and all that type of stuff, funds of funds are actually made up of owning multiple different funds. So they're basically taking existing funds and investing in them as opposed to individual equities and bonds. So again, to really clarify this, traditional funds, they'll maybe pick a specific sector and then invest and focus on them ones. So for example, you might have a fund that focuses on tech stocks and will invest in them, or one that might focus on UK companies, or one that might focus on different types of bonds. A fund of fund, however, that won't pick specific stocks or bonds to invest in. They'll invest in the funds themselves. So the previously mentioned 3 funds, they would actually invest in them and gain the diversification through these funds owning them assets as well. And diversification is the name of the game when it comes to funds of funds. By accessing it into all these different funds that are covering different markets, in theory, they're more easily able to diversify across a broad market of both asset classes and geographies. And this is what retirement date funds do. They are fund of funds and they're normally investing into other funds themselves. What makes these funds further special from normal funds of funds is that when you invest in them, you'll be asked your target retirement date. And based on the age that you put in there, the closer you are to that intended age, the allocation within the fund will change. This comes in the form of when you're further away from your intended retirement age, there's going to be a heavier emphasis on equities, which are traditionally seen as higher risk. And as you get closer to your intended retirement age, that allocation will switch. So it might be, if you're 30, 40 years away from retirement, it might be something like 90% in equities. But as you get to 10, 5 years out from retirement, it's going to be a much heavier emphasis on bonds as opposed to equity. So that 90% in equity might drop to like 30, 20%, and then the majority of it will be in bonds instead. This general change over time, it's highlighted by this graph here, and it shows clearly from left to right, as you move closer to your retirement age, the allocation that's in bonds and bills, which is just government bonds basically, highlighted by grey and, well, like lilac or lavender, I'm not really sure what colour you'd call that. That proportion increases as you move towards the right or as you move closer to or into retirement. The reasoning and thought on why these funds do this is that as you approach your intended retirement age and when you would begin to withdraw money from this fund, they basically want to decrease your volatility so that when you're withdrawn from these funds, there hopefully isn't a big spike or drop in the value of the assets when you begin to withdraw from it, as that will leave you open to something called sequencing risk. Now, obviously, this does sound all good in practice, and obviously there is much worse things to be invested in building up to retirement. And that's worth quickly talking about. Ultimately, the best investment plan for your retirement is the one that you'll stick to, the one that you'll consistently invest into, and the one that you just won't touch. So if these target date funds do that for you, then more power to you. it's much better than the alternative of not putting money into anything. But with that in mind, if you're like me and you like to be as efficient as you can with these types of things, when looking at these target date retirement funds, I see some rather serious issues. The biggest of these is that these funds expose you to a serious type of risk, one that's different from sequencing risk, admittedly. That risk is, well, it's the risk of running out of money. This issue is highlighted in a recently revised paper called Beyond the Status Quo, a critical assessment of investment advice. This paper basically looked at different asset allocations for retirement portfolios and then looked at the real utility of them when it came to, well, retiring. This is a super interesting paper. It's kind of shaken up the world of investment advice and retirement advice, as it kind of goes against the traditional norms when it comes to asset allocation. And the reason it's doing this is because it doesn't use kind of the industry traditional ways of measuring risk, which is normally just volatility, which, in my opinion, over the long term when it comes to planning for retirement is a pretty ineffective way of actually measuring risk. And I think that the risk of running out of money is a much more prevalent way of measuring risk when it comes to these things. It also uses an interesting way of sampling data. I won't go into it. It uses like a bootstrap method to basically simulate way more periods of time to allow for a larger array of scenarios to be bared in mind to really cover our bases as best they can with available information. I really like to get a deeper dive into this paper and make a video on it for the channel. So if you'd like to see that, be sure to drop a like and comment down below that you want to see this video made, as it can be quite technical. So I think it would be good to maybe break it down so that more people would be able to understand its findings and implement it themselves. And be sure to subscribe to the channel as well, as it does help out and it would notify you if I do end up making the video so that you can come back and give it a wee watch. Now, thankfully for the topic of this video, one of the benchmarks used in this paper is actually the standard target date retirement fund. And as such, we see it being directly tested against other types of portfolio allocations to see how it stacks up when it comes to effectively saving and lasting through retirement. I'm now quickly going to throw up a series of charts, and on these charts, bear in mind that the target date fund is denoted as TDF on the charts. Anyone who's interested in a bit of a geek like me and wants to look at these graphs, you can just go ahead and pause the video and have a look at them. But for the purpose of this video, I'm going to focus on two of these graphs specifically. We're specifically going to look at the wealth at death chart, which is basically just how much money you've got left after you kick the bucket to give to whoever you want to inherit your money. And then also the financial ruin probability chart, which basically just shows the percentage chance of you running out of money in your retirement. Now, for those that aren't comfortable reading box charts, the important thing to bear in mind with these is the wee purple line, as that's just the average. And when looking at the averages, we can see that the target date fund is actually the second worst out of all the benchmarks. It only manages to beat out the government bills, which isn't really much of a high bar to beat, frankly. There's further graphs in this paper that go into more detail with the financial ruin section, and basically shows the different scenarios that lead to the financial ruin. So that might be super high inflation for a period of time, or it might be you living way longer than was initially planned in your retirement. And again, in these graphs, we can see that the target date fund, which is denoted as the wee square on the graph, in the extreme cases of high inflation or you live really, really long, it ends up being the worst and is the most likely to cause financial ruin, which is you're running out of money in retirement and you're going to be back working the kiosks or flipping burgers at 100 or 110, which doesn't sound ideal. So what is the issue here? Why are they not performing so well? It really comes down to the fact that the measure of risk as volatility is somewhat flawed when it comes to retirement planning. As yes, volatility is a form of risk, but in the long term, volatility leads to higher returns and more money as a result. So yes, in the short term, using volatility as a measure of risk is appropriate, but when you're planning this out for 30, 40, 50 years, volatility is necessary to grow the amount of money that you need to comfortably beat inflation. And as a result, you can more comfortably last in retirement given extreme circumstances. So when you've got these target date funds that have a higher proportion of bonds and government bills, which yes, have low volatility risk, but also means that they're generating lower returns as a result, which amplifies the risk that I spoke about earlier of the risk of just running out of money. Now, obviously, these are just scenarios, and financial ruin isn't exactly guaranteed. if you're going to have periods of super high inflation or you live in 20, 30 years longer than you thought you would have, as realistically you would just adjust your spending, spend a bit less. But obviously that's still not ideal. If you had a certain level of living that you're wanting in your retirement, needing to sacrifice that because of these funds still isn't exactly a bragging point for them. Now, moving away from the graphs and the technical side, the one other big point of pain for these target date funds is the fees. The fees on these funds are noticeably larger than the general broad market index funds due to their semi-managed nature. And obviously these larger fees are going to eat into your returns over the long term. And there isn't really a justifiable reason for these really cost higher fees, as by the scenarios, they don't seem to be making you end up with more money as a result. So with these points of pain in mind, you've really got to ask yourself, are they worth it for the supposed upsides that these funds provide you? Especially when it's supposed upside of providing a safer and more secure retirement. It's kind of challenged in papers like the one in this video. Before we finish, I just want to really emphasize one thing. This video isn't to bash on Nischa at all. These topics, especially when we're getting into stuff like specific fund types, are really quite niche. On top of the fact that new info, new studies, they're coming out all the time. And as such, keeping up to date with all this stuff, it is really difficult. And as such, realistically, no one person is going to be able to know everything when it comes to this field. This is a good highlighter to emphasize the point of getting your info about finances in retirement from as many different sources as you can, especially if you're the one that's in charge of your finances. Because much like how diversification of your assets is going to be a good thing for your retirement, diversification of your research into finances is only going to be beneficial for you as well. And obviously that goes for me too. I'm likely going to make mistakes moving forward, and I'll speak about things and cover topics that might become out of date a year, 2 years later. And as such, it's critical that you just research yourself, be diligent and scour all the sources that you can. One tip I'll give about that is to specifically seek out contradicting opinions. So, for example, to use target date funds, if you've seen a couple videos that are really promoting them, saying the benefits, why you need to invest in them, try Googling something like why target date funds are bad or the problems with target date funds to see what results come up then, see what the critics are speaking about them, to get a good balanced view, you know, both sides of the fence, to let you come to an informed decision yourself about what you want to do with these types of things. These are really important topics and choices that will have a real impact on your life. So take the time and do the research, as the future you might be really sorry if you don't. Admittedly, it's a bit heavy and it might sound a bit overwhelming. So if you feel like that really isn't something that you can do, at least consistently throughout time, consider reaching out to a professional like a financial planner. They'll be able to sit down with you, speak through your situation and keep you up to date. And then if you're signing up with them, they'll keep you up to date throughout the entire process and make sure that everything's on track and you can kick your feet up and not need to worry about it. With that, I hope you found the video interesting. If you have, be sure to leave a like and subscribe. It really does help the channel out and only takes a second. And it doesn't cost anything, so you know, no downsides. And again, if you want to see a deeper dive into that previously mentioned paper, be sure to leave a comment down below as well, as I do really want an excuse to go into it, but likely take a bit of planning and a bit of work because it is comprehensive and will be hard to break down into layman's terms and all that type of stuff. In this video, we covered topics that really can impact your retirement. But in my most recent video, I talked about 8 things that you should really stop in the build up to retirement to really enjoy yourself. So be sure to check that out. And if not, until next time.